All right, so good morning, everyone. Welcome to the Macro Snapshot. We are at the end of the month, so it's July the 31st, 2025, recording this in the morning. As always, it's about 7:30. Okay, guys, so let's just look at yesterday a little bit. Some quite interesting stuff happening. Let's take it in order of what happened throughout the day, because the markets have repriced quite a lot in the last 24 hours. So what we can see if we look here at the, sort of move something here, if we look at the data from yesterday, it started off quite strongly with ADP, and we all know that it's not perfectly correlated to the non-farm payrolls. But nonetheless, that started the day off at 8:15 with 104,000, so higher than expected, and certainly much better than last time, which was minus 33,000. So that started the day off on a sort of a positive footing. So equities quite liking that, the bonds, especially the front end, not liking it, and the US dollar sort of looking, liking that as well. And the question here is as well is that. The US dollar was very, very sort of oversold. If you look at the positioning, just looking at, like, for example, the commitment of traders, the market was very, very, very short. So we're also getting a combination here from both sides of the short squeeze. So those weak shorts, or those shorts who sort of shorted quite sort of late, they have to sort of cover, and that's causing some short squeezing. Plus, you have some relatively sort of hawkish or bullish kind of data. So we started that off, and then we got the quarterly refunding announcement, and that actually was a lot less dramatic than some people had sort of anticipated. And there are maybe two things to look at. First of all, they did not cut the coupon issuance. There was no sort of major sort of cuts to the coupon issuance, which some people are saying, and that's sort of indicating that maybe the Treasury and even sort of Treasury Secretary Bessent is anxious not to do anything too radical. So that for me was a bit of a surprise. They didn't do anything at all. And they also said that they're going to maintain the nominal coupon sizing for at least the next several quarters. So really the message coming out of the quarterly refunding announcement was one of stability and incremental change, rather than some sort of crude attempt to kind of push down long-term yields by cutting the number of the issuance of coupons. So that was interesting. That was quite subtle. Having said that, they didn't really sort of alter the composition that much. What they did do is to increase the buybacks. So basically the buybacks have gone from 30 billion to a maximum of 38 billion per quarter. And buybacks here is understood that those illiquid or lacking liquidity off the run sort of bonds with the sort of longer durations, they essentially will be bought back from the market to ease those out of the market to smooth market functioning. And they've earmarked a maximum of 38 billion rather than 30 billion per quarter. So that's not such a huge change, and it's quite a subtle sort of way of just trying to sort of keep that illiquidity premium down. So that was didn't cause too many market ructions at 8:30. On the other hand, what we also had at 8:30 was the GDP decision. And on the face of it, this was quite strong. So you see here that the headline number was 3% instead of the expected of 2.6%, and much more than the negative 0.5. So again, this sort of cacophony, almost this sort of constant drumbeat of sort of positive data continues. And now we could look under the hood a little bit at that, because you could start looking here at personal consumption and say that was actually down a little bit. But if we actually look at that, I've got a couple of charts here, and some people were saying and pointing to the fact that although the headline number was quite strong, if you start looking at this particular number, and this Powell in his press conference later yesterday talked about this a lot. So this is the real, so inflation adjusted final sales to private domestic purchases. And a lot of people, and analysts, commentators, economists, look at this number in the GDP as a better sense of what's actually happening to the real economy, because the headline number, which we saw was quite good, that can be distorted by sort of import, export levels, inventories, a lot of stuff. This number here tells us maybe a little bit more about just are people sort of confident in buying stuff. So you see here that in the sort of the paler blue is the GDP, which, as you saw yesterday, was 3%. But if you actually look at the final sales to private domestic purchases, that was actually 1.2%. So you see here, this number, which is the dark blue, actually sort of coming down a little bit. And another way of looking at that here there's a couple of different ways of looking at that here, but a similar kind of thing. You've got the orange and the blue here. You see that that's been sort of slowly sort of moving down. And I think also, again, just got this similar kind of numbers here. You can see here again, just this sort of contrast between the headline number and the sort of just the actual sales. So the question is the GDP, there's two ways of looking at this because the headline number, and that's the number which the market went off initially, was quite strong. Or at least, let's put it this way, even if you could say that underneath it, there are certain elements which are slowing down. And that definitely seems to be the case in the labor market and even in like some of the personal consumption numbers. And we have credit card delinquencies starting to creep up. The reality is that I would say the US economy, in my judgment, is not booming, but it's certainly not collapsing off a cliff. It's kind of just, in a relatively robust way, just sort of chugging along, motoring along. And this, I think, is going to be important in terms of how Powell, it characterized everything. So, of course, what we also then got was Powell. And let's just sort of look at a little chart, just to give you a sense. I just sort of pulled this one up. This is a 3-minute chart. So you can see here when Powell started speaking, you see here that initially the market took this as being quite hawkish. So basically, what did Powell say? Powell very much, again, much like the Treasury, resisted the institution resisted the pressure from the presidency to cut interest rates. And obviously they didn't cut interest rates. What he did say, I just took a few notes here. He basically said that the service inflation has moderated lower. So that's a positive. But what Powell was saying is that goods, so sort of stuff, that's actually, is starting to sort of creep a little bit higher. So it's almost as though the service inflation is coming down, but the goods inflation has remained sort of quite it has is sticky and maybe even is going up a little bit. And Powell did say that in terms of the tariffs, he was quite even-handed, I thought. He basically said, listen, it could be a one-time price increase. So it will not lead to sort of permanent inflation. But the reality is that we don't know that yet. We need more data. And before the September meeting, there'll be two more sets of data in terms of inflation and jobs. But what he did say, which I thought was interesting, and he said, and by the way, there won't be any inflation because if the tariffs prove to be not a one-off price increase, so a little more sort of permanent, he basically said the Fed would try and crush that inflation. So interesting that he essentially said, hey, either we won't get the inflation, or if we do get inflationary effects from the tariffs, we are here at the Fed to crush it, which was quite hawkish. He's basically not saying, oh, we're just going to ignore tariff-caused inflation and cut interest rates. He didn't say that. So I think that's why the market is starting to take away a slightly sort of hawkish interpretation of that. Although he was very, very careful to say he's data dependent, and he's saying that, broadly speaking, inflation wasn't horrible, but it was still some way off their target. And because of their twin mandates, are doing. They have to look after those twin mandates. So one mandate is, and actually, by the way, talking about the mandates, someone asked about growth, like what would happen if growth were to slow down. And I thought it was interesting what Powell said, because Powell's response, he said, well, hey, growth is not one of our mandates. Their mandate is price stability, which means to control inflation, and full employment. They don't have three mandates. They don't have a third mandate saying, oh, induce the economy or pump the economy or keep growth high. So it's almost as though Powell was saying, hey, he doesn't really care about growth, although of course he probably does, but sort of technically, ostensibly on the surface, he doesn't care about growth. The employment situation is very strong at the moment, so there's no need to panic. And inflation is still a bit sticky, and it could rise even if it's a one-off price rise with inflation, with tariffs. So all that to say that he's in no hurry. And personally, I think what will happen is that they'll get a bit more data. And remember that they always meet in Jackson Hole in August. And that possibly could be the moment where Powell, with more data, decides to sort of signal the possibility of a cut. And what was interesting is that he also said about the tariffs, he said that in his judgment, that definitely some of the tariffs would be borne by consumers. So Powell acknowledged that for sure, exporters, importers, and companies would maybe eat part of the tariffs, but that fourth group, which is the consumer, some of the tariffs would be priced on, which probably, according to Powell, would be at the margin at least a little bit inflationary. And talking about tariffs, we've got another news overnight of a sort of another deal. Trump announced the 15% tariffs, more or less, on South Korea. So it looks as though generally what we're starting to see, we're starting to get a bit more clarity. We still don't have any information about China and sort of various sectors, but it does seem that in general, what we're starting to see is about 12, 15, 18%. So let's call it around about 15% on average. And you've got to say that 15% tariffs, I'm not going to predict some crazy inflation, but they're certainly not deflationary at this point, although they might slowly push down growth over a 3, 6, 9 months time horizon. But you have to imagine that with approximately 15% tariffs on all imports into the US, at the minimum, we're going to get some one-off price rises, which could cause at least a little bit of inflationary pressures. The other thing which I just want to talk about with Powell is that he did mention that the unemployment situation or the employment situation was strong, the labor market was strong, but he talked a lot about the unemployment rate and he put a lot of focus on the unemployment rate, and that's what we need to be looking at. And of course, we get an update on tomorrow, on Friday, from the non-farm payrolls. And his point being that even though the economy was not creating, millions of new jobs, or let's say many new jobs, the pool of available workers was actually sort of shrinking as well, probably because of the immigration policies of Trump. So essentially, what we have is kind of this balance that maybe the economy is not creating all these jobs, but it's not as though the number of available workers is increasing, which would cause the unemployment rate to go higher. And so Powell was saying that we're sort of in this awkward balance here, that maybe the labor market wasn't incredibly strong, but it's sort of okay, and the unemployment rate is okay because, as I say, there's not a huge amount of new workers coming online, and therefore that's why that was the basis, sort of the theoretical basis of why he personally is very, very focused on the unemployment rate. So let's keep an eye on the unemployment rate. And generally, the takeaway was from Powell that if the unemployment rate were to rise, that would seem to be one of the preconditions for him to maybe think about cutting rates. So let's keep a very good eye on the unemployment rate. So as you can see here, just looking at the Nasdaq on the 3-minute chart, this is when Powell was speaking. You see the market wasn't liking this in terms of the hawkishness, and we saw the front end rates go up a lot, which I'll show you in a second. But then, of course, we had the earnings, and of course, suddenly, as we got towards after Powell had finished speaking, and we had the earnings release here, which was very, very positive, really, very positive earnings from Microsoft and Meta, and quite strong sort of future forward guidance from both of those huge companies. We see that the Nasdaq, especially, absolutely ripping. I mean, it's kind of calmed down a little bit, but basically bringing back, or taking away, I should say, all of the losses from Powell's hawkishness. And you can see that overnight, basically, Nasdaq, for example, and ES, let me just bring it back to the daily chart, you can see making new highs. And if we go to the S&P 500, also trying to push up towards new highs. I'm just going to grab some tea. Excuse me for that. On the other hand, the bond market didn't like it too much. And if we look at something like the front end of the curve, we look at ZT here, which is the 2-year. You can see here a bit of a red candle, so pushing down. Listen, the market is still expecting at some point a cut or two or three. Now, whether it's going to come in September, October, December, January, February. So for the 2-year, it's sort of annoying, but the market is still very much pricing in some cuts. Although for the Fed funds futures and the SOFRs, they definitely took out about 10 basis points. So that was a bit nasty at the front end. So you see the front end came down a lot. But if you look at, let's say, something like the ZB, the 30-year, you can see it didn't come down quite as much. So we did have a little bit of a flattening on the curve here. What did the Powell's prognostications? And Powell, again, basically, let's see what he said. Just looking at the dollar index here, Powell essentially said that the U.S. economy was in a pretty good space. There was the possibility, potentially for some sort of slow down at some point if the tariffs were to cause sort of a loss of sort of purchasing power, and inflation was still a little bit sticky. But Powell was relatively upbeat about the economy in general, and of course, people still have jobs. And therefore, as we continue to get, Powell not cutting, and also the real economy giving us, quite, solid data, maybe not spectacular, but solid data. The US dollar here is kind of loving that. And you can see over in Europe, for example, we had European some sort of economic indicators this morning, which weren't sort of super positive. So we're starting to get the US dollar here, as I say, very, very oversold. A lot of, a bit of a short squeeze, maybe some position unwising. And also just a sort of a sense that the US dollar has come down 12% this year. I think it's like 11 or 12% from the high here. Actually, we may as well sort of have a quick look and see what it came down. Yeah, it came down 12.2%, which is kind of a long way for 4 or 5 months. And you can see here that we're starting to see some of these moving averages turn over. Now, just from the technicals here, interesting point here that if we look at this most recent down point, the impulse from, let's say, the 12th of May, which is here, we're now at the 68% fib retracement. We're also coming up to the 100-day EMA. So we are starting to get to some interesting technical resistance. And this purple line here is 100. So kind of the psychological level. I don't know how much importance we put onto that. But basically, this is an interesting point here for the bulls. Can they keep pushing higher? Or will the bears kind of step in and say, great, this is a more attractive selling point? For sure, that's an interesting point to be selling. But it's kind of interesting today. And as I say, we do get a lot of data and we get our data tomorrow. So probably by tomorrow afternoon, Friday afternoon, either this will be up pushing up here, pushing up towards the 200-day moving average if the data is all strong. Or if the data kind of contradicts what we've had, that contradicts the data we had yesterday and the Fed's opinion. Of course, this could just be seen as a short-term sort of technical bounce, and we could be on the way down. So pretty interesting time for the dollar. That's also reflected in some of the other currencies, of course. So we look at the euro, similar kind of situation here. The euro's gone down lower than its fib retracement. It's also going down towards the 100-day moving average. So euro losing strength. We can also see the Japanese yen losing a bit of strength. And that's interesting because we had the Bank of Japan last night. Now, the Bank of Japan, they held rates. That was kind of expected. What was interesting, though, in terms of their revisions and forecasts, there were no downward revisions to the GDP because of the tariffs. So I would say, just looking through the statement, which I looked at this morning, that in terms of the dangers posed by tariffs, the Ueda in his press conference also said that for sure there are still some downside risks. But my takeaway was that they weren't overly concerned. And I almost have a feeling that with a little bit more clarity, if you look at the forecast for GDP for the rest of this financial year, then 26 and 2027, there weren't that many sort of downward revisions. And if you actually look at inflation, the core inflation for the financial year of 2025, was actually revised upwards from 2.3 to 2.8%. So that's telling you that the BOJ thinks that core inflation is remaining sticky and actually maybe is sort of still got some upward movement, which would implicate to me, which would imply for me the implications are that now that the tariff situation is sort of stabilizing and inflation is remaining a bit sticky, that the BOJ Ueda certainly didn't say this in the press conference, and you can see that the Japanese yen didn't particularly rip or anything, but Ueda is maybe just slowly and subtly preparing the way for a hike, maybe in October or so. So that's an interesting one to be looking at. So as you can see here, yeah, the US dollar just broadly against the pound. You see the pound losing out, even the Swiss franc here. If I can bring that up, where's the franc? The franc also losing out. So basically all across the board, US dollar doing pretty well. And I would say if the data confirms that sort of strength in the US economy and gives the Fed no reason to think about cutting, there's no reason why the US dollar, I believe in the next 48 hours, the next two trading sessions can't keep on pushing a little bit higher. Let's see what happens there. Just a couple of other markets we want to have a look at. Let's have a look at oil. There's been a bit of saber rattling between Trump and Russia, basically Russia telling the Americans to shut up, more or less. Medvedev, the prime minister, Trump this morning, I saw telling him that he was a failed prime minister before, and who thinks he's still the president. But basically, there's some sense that the US might at some point impose more sanctions. So let's keep an eye on what's happening to oil. As I say, the global economy is doing okay without being sort of accelerating. So you see there's a big sort of downtrend here on the oil, on the WTI generic front contract. So oil's pushed up to that. So that's kind of interesting, showing a little bit of strength. But again, just trading in the middle, see this sort of purple box here. This has been a big trade range. If you go back quite a long way, you can see going back quite a long way. So we're just in the middle of the trade range here. Having said that, oil, it has sort of bounced off this big fib level. So if you want to do a fib sort of movement here, you could say that, if this whole big impulse here on the Iran situation on the 68% retrace, it did bounce off that, retested lower and pushing higher. So it's relatively sort of strong. We had a couple of big candles. You see that was very, very flat. All these moving averages pushed above the 200-day EMA and now poking its head above this downtrend, which is going to be quite important. Let's see what happens today. If the data remains strong, and maybe sort of tensions between Russia and the US sort of calm down a little bit. This is going to be key because if oil can push up here, it can maintain this sort of level and is not sort of stalled by this downtrend line. We could see oil pushing a little bit higher. Okay, final thing I just want to finish off with here. Actually, not the second final thing. Let's just look at copper, which had a crazy move yesterday. For those who, hopefully, some of you were long. I know some people were short, but let's have a look at copper here. And pretty simple. I just want to first of all look at the London price. So you see grade A copper. This is the price out of London. And as you can see here, we never had any crazy moves upwards and obviously a big move down yesterday. But if you go across to COMEX, this is the price which was this is traded on the US exchange. And basically, you can see here we had this huge pop on the idea that Trump is going to introduce 50% tariffs, so much higher than expected tariffs on copper products. So therefore, all traders, they physically shipped in to try and take advantage of this arbitrage between the London prices and the New York prices on COMEX, with the idea that there would be a huge sort of premium because of the copper tariff potentially coming. So that's what explains this huge green spike a couple of weeks ago. But then yesterday we actually got a sort of a headline and some information coming out about the copper tariffs. And as you can see, I think it was I read so it was the biggest intraday drop. You can see here we're still going down. So we're down 23%, 23%. But again, just on the New York price here, and because that sort of risk premium, the tariff premium compared to London and Shanghai prices has completely collapsed. And that's just because that the 50% premium is going to be imposed, but on semi-finished products only. So semi-finished products and not on refined products. So any refined products, and a lot of refined products are going to be excluded essentially from the tariffs because Trump, there was a lot of pushback from industry in the US saying, hey, Mr. President, we don't actually have this stuff. And if you put a 50% tariff, it's actually going to destroy a lot of the industrial processes in the US or make them much, much more expensive. So Trump and the White House here seems to have relented and basically they've excluded all refined products. So the semi-finished products they're the ones getting the tariff, which means not all products are getting the tariffs, not all copper products, and therefore the market has been obliged to let's just put it charitably and say reduce the price but that's a crazy move there, incredible volatility here. And copper, it looks even overnight still going down a little bit more. So it looks as though the New York price wants to flush out. Wouldn't surprise me. The next level is down here at about, let's call it about $4, just under $4. We'll just make a nice little line down here because that now means there's possibly a bit of a surplus in the COMEX exchanges in New York, and they have to basically be sort of redistributed around the world. And again, I just want to sort of compare that chart to what happened in London. You see London a lot less volatile. So that's really a function of that arbitrage between New York and London. So just finally, guys, we do have some data this morning. Actually, of course, we have earnings. So let's have a look at the earnings. We all know that, as I say, yesterday we had Meta and Microsoft doing super, super well. Today, after the bell, I mean, we have some interesting ones this morning. We have MasterCard, Roblox, CVS, etc. But really, the big ones got to be Apple and Amazon, which are obviously different companies compared to Microsoft and Meta. So it's going to be interesting. And if they can sort of have beats, you've got to say that maybe the stocks will be sort of pushing higher and higher. And that's the new all-time highs. But in the meantime, this morning, we do get some data coming up in about 45 minutes. As always, pretty interesting. We're going to get the initial jobless claim. So again, Powell's point seems to be that the labor market is strong. What's Ferrari doing these days? 709 million. Okay. So Ferrari, I think they have an order book going back or going forward for several years. So I just want to see if Besant on the descents looks like already schism on Fed board. Would be highly unusual for Powell to stay on. We'll be interviewing people for the Fed. Would expect Fed nomination announcement by end of the year. Will be 2 seats opening up on the Fed board. Right. So that's interesting. Besant this morning putting a bit of pressure. Just because yesterday at the Fed, Powell was asked whether he would stay on on the board of governors after he left as chairman, and he made no comment. But obviously, Besant and the White House putting more pressure. They really want Powell out of there. And secondly, yes, there were 2 dissenters yesterday, but that was kind of expected. We had Bowman, and we also had, of course, Waller, who had that big speech a couple of weeks ago, which was quite dovish, and outlining his views for why they should have cut yesterday. So that is interesting because definitely there were a couple of dissenters who wanted to cut yesterday. Whether that's, part of a bigger schism, or sort of split on the Fed board, I don't know if that's the case. We shall see, I guess, over the next few meetings. But just getting back to the data this morning, we do have, actually, I'm just going to update this. So let me put enter. Right. So what is interesting, we do get the core PCE. Now, some people calling the month over month are calling for a slightly sort of a hotter number, maybe even up to 0.4. That's going to be interesting because the Fed will not like that if the core PCE for the month goes up. Let's keep an eye on this number here, month over month one. The employment cost index as well is an important input because that's not only wages, that's also the cost of sort of healthcare, insurance, sort of benefits, holiday pay, all of this stuff. This is the total cost which employers have to bear to employ someone. So 0.8, supposedly meant to be less than last time. So that's quite an important inflationary input. So that's definitely one to be looking at. If that's higher than expected, along with the core PCE higher than expected, the front end of the bond market will not like that at all. Of course, as always, we get the initial jobless claims, very, very solid labor market. Anything in the 220s is very, very good, indicates no problems. Let's keep a look at the 4-week moving average and the continuing claims. And we do also get a bit later on at 9:45 Chicago PMIs for July. So that's a bit more sort of recent, expected still to be in contractionary territory. So let's keep an eye. So some very interesting data here. Also, we're going to get sort of personal spending income and real personal spending. That's probably an important one as well, just to see whether the US consumer is spending. So this is going to be another interesting input. And just finally, to see where all this is going, you can see here on December pricing for the Fed funds futures. You can see here on the intraday chart. So this is just, that's one day. You can see yesterday we were pricing about 46 basis points by the end of the year. So almost 2 cuts. But as you can see, once Powell talking at the news conference and with the strong data yesterday, the market pretty aggressively in a hawkish repricing. We're now down to, and even this morning up a little bit, down to 34 basis points. So essentially took out half a cut. So that's going from 46 down to about 34. So that's 12 basis points, which is about half a cut. And you can see here, indeed, by the end of the year now, we're now down to 1.35 cuts. So remember, recently over the last month, I've been saying it's always about 2. It's always about 2, 1.9, 2.0, 2.1. We're now down, we're getting now down towards just over 1 cut. So definitely a pretty hawkish repricing yesterday for the end of the year. Only 35 basis points priced in rather than 50. So the front end of the curve not liking that at all. If the data comes in today and tomorrow strong, you have to say that that's probably going to go down to 1 cut only by the end of the year, which is not great for the SOFR contracts and things like the TUA. On the other hand, if the data starts to weaken, of course, that can be flipped very quickly as well. So pretty interesting days today and tomorrow. And probably we're also going to start getting some Fed speakers coming out. Maybe we'll get the dissenters. We'll get Bowman and Waller as well today, just explaining why they dissented yesterday. And no doubt our friend Trump will be tweeting about too late Powell today. Okay, I'll leave it there, guys. Had a lot to say today, so we'll keep the conversation going, and thank you.